Welcome back to Kitco News. I'm Jeremy Safran. Well, inflation is easing, on paper at least. Now, the U.S. Producer Price Index rose just 0.1% in May, and that's less than expected. And core CPI, released earlier this week, slipped to 2.9%, and that's the lowest annual pace since early in 2023. Now, markets are wasting no time. Bond yields are falling, and the U.S. dollar just hit a three-year low. Gold, meanwhile, is holding above $33.50 per ounce on the spot side, and traders are now fully pricing in 2 Federal Reserve rate cuts by year-end, with growing odds for the first move coming in September, according to the CME FedWatch tool. But while market rates expectations are moving down, trade risks are moving up. The U.S. collected a record $23 billion in tariffs last month, a 270% increase from a year ago, and President Trump says dozens of countries will receive letters within 2 weeks setting new unilateral tariff rates unless deals are reached by July 9th. Now, that pressure is being felt globally. The World Bank just downgraded its 2025 global growth forecast to 2.3% and now warns that this decade could mark the slowest pace of expansion since the 1960s. So, what are we looking at, and what does that mean for our accounts? Economist David Rosenberg says that the U.S. recession isn't coming, it's already here, and it's not just a perma-bear take. He's predicted the 2008 financial crisis. He warned about the COVID crash well in advance, and now he says the same blind spots are resurfacing again in job data, in earnings, and in consumer demand. Let's welcome our friend David Rosenberg. He's a chief economist and the founder of Rosenberg Research, and he's joining us now from Toronto. Good to see you, Dave, as always.
Thanks very much, Jeremy. Great to be back on.
Yeah, it's good to have you because we're under, we got this new data coming in, of course. I kind of started with that. Let's talk about your central thesis, that the U.S. economy is already in recession, not approaching one, not avoiding one, kind of already in it. I mean, the Fed's Beige Book still describes the economy as expanding, and stocks, as you know, are near all-time highs. And official GDP data, while it's weak, it hasn't really signaled a full contraction yet, according to the officials. So let's talk about the hard evidence that you're looking at that confirms the recession has already started here.
Well, let's say that the U.S. economy looks to be entering into a recession. I could see the other side of the debate that it's not here yet, because not every indicator is pointing that way. Mm-hmm. However, back to what you mentioned regarding the Beige Book. The Beige Book actually said that 3/4 of the country is either in stagnation mode or contraction mode right now. And I always look at the Beige Book. Some people might call it soft data. It's been around since 1970. It's produced by the Fed, comes out every 6 weeks, and it is the most comprehensive assessment of the U.S. economy across geographies and across industries. And whenever you get to that diffusion index where 3/4 are either flat or negative, a recession is already underway. And I put a lot of faith in the Beige Book because it's not only timely and reliable, but unlike a lot of the economic data, what they call the hard data has a high error term in the first releases, no matter what you see, whether it's GDP or whether it's retail sales or whether it's nonfarm payrolls. The sampling error is high in the first release, which is why you get all these wild revisions down the road. And that's what had everybody so confused back in the Great Recession, which the NBER dated after Lehman collapsed. They dated the recession starting December of 2007. When all you heard back then was elongated soft landing. The Beige Book tone back then was equally soft as the one that we just saw released just a couple of weeks ago. So that's just one indication. I found it very interesting that in the last set of FOMC minutes, and of course we're going to get a fresh meeting next week, but the last FOMC meeting in May, the minutes came out a couple of weeks ago. What did it show? Well, in the FOMC minutes, in the preamble, it always has the Fed economic staff forecast being revealed. And the Fed staffers said that not only did they cut their GDP growth forecast for this year and next year, but they said that the risk of recession was equal to the risk of their new lowered base case forecast. 50-50. And this is from a usual cheery bunch called the Fed economic staff. So you tell me what other asset class that's out there right now is even priced 50-50 or remotely for a recession.
Yeah.
So these are some of the more recent indicators that I'm looking at. Of course, there was a bit of a false glow to some of the spending numbers that we saw. And of course, you saw that at several months ago with the booming imports feeding into inventories. There is tremendous pre-tariff spending, and it gave this artificial glow to the data, but just creates a huge vacuum for the data in the future because so much of that activity was borrowed. You saw that in Canada, and in Canada, it looks like second quarter GDP is going to be flat as a beaver tail.
Yeah.
But in the U.S. too, a lot of the spending activity was really artificial in nature. But you're seeing it, like I said, the Beige Book, the Fed staff forecast. We had both the World Bank and the IMF. I think that they're basically saying that real GDP growth in the United States this year and next year will be little better than 1%. And when you go back historically, when you have back-to-back years of 1% plus real growth in the United States embedded in that time frame is an actual NBER-defined recession. So I guess I would rephrase that we're 100% in recession because nothing is ever 0 or 100%. But
Right.
I would say that those risks are high, those risks are elevated, and nothing is priced for it.
Yeah. Yeah. I mean, you look at that continued jobless claims too. I mean, they're up 14% year over year. Real gross domestic income, the GDI, it's been negative in 2 of the last 3 quarters. That metric usually leads GDP in turning points.
Right.
Why isn't that being factored into the broader market narrative? I mean, what data is Wall Street looking at here?
Well, look, in terms of the second part of the question, here's the dilemma. So many of us were calling for recession in 2022 and 2023. We had a Volcker-esque style tightening cycle by the Fed, 500 basis point interest rate shock, and an inverted yield curve, but the recession never came. And so it's a case of once burned, twice shy. Once you get a big call like that wrong, you're sort of going to just keep your mouth shut. No, that's not me, because I understand why that was a blown call. Is because you had the massive Biden fiscal stimulus as a major antidote to the fiscal tighten. Not only do we have the lingering impact of the $2 trillion plus of stimulus checks, and all of it got spent, which was remarkable. But then all the other stimulus that we had coming out of the prior administration kept the Energizer Bunny going and acted as an offset to what the Fed was doing. We're not having that degree of fiscal stimulus this time around. It's a question of what sort of restraint are we going to be seeing when you look at all the numbers coming out of the big, beautiful bill. It doesn't really add a whole lot of stimulus. In fact, when you look at it, it probably ends up imposing through the spending cuts a moderate amount of restraint. And interest rates are still pinned by the Fed more than 100 basis points above their neutral level. So monetary policy is still tight, and the Fed keeps on telling you that policy is deliberately restrictive. Remember when we went into that situation calling for recession, and maybe the big mistake I made was not realizing how far the Fed had to go. Because in real terms, the funds rate didn't go into positive territory until we were into the spring of 2023, and the tightening cycle was almost over. So that whole period of the tightening cycle, the Fed was just scrambling to get out of major accommodative territory. Right now, the real funds rate is not negative. The real funds rate is more like it's over 2% plus. We basically have real interest rates back to where they were in October 2007. And 2 months later, the recession started. So there's a critical difference in terms of where real rates are, in terms of where the money supply growth is now vis-a-vis then, And you mentioned the claims numbers, and you're 100% right. The claims numbers are now telling you two things: the spot initial jobless claims are hooking up,
Yeah.
and are telling you that the layoff cycle, which had been dormant, is now moving into full gear. And actually, that came through as well in the latest JOLTS data. Everybody looked at the job openings numbers that went up. But job openings are not the same as layoffs and not the same as hirings. Job openings are sort of like a fugazi. You can
Yeah.
post a job, test the waters, but doesn't mean you have to hire somebody. The hiring rate in the United States is like a hot knife through butter. It is going way down. And that's what's being reflected in the backlog of continuing claims, which is what you talked about. We're over 1.9 million at a 4-year high. And what that's telling you is that it's becoming increasingly difficult for the ranks of the unemployed to find a job.
Mm-hmm.
And you connect the dots there to what the JOLTS data are telling you with the hiring rate. And what I'm looking at, which is not apparent yet in the non-farm payroll data, but for the past 3 months, the JOLTS data have told you this very important statistic, because nobody will believe that we're in a recession until the labor market really starts to crack, although the labor market, being a lagging indicator, is always the last man standing. But when you go to the JOLTS data, you're going to find that layoffs have surpassed hirings in each of the past 3 months. And so we are on the precipice. When you look at the hiring rate in conjunction with the firing rate, and now we're looking at the claims numbers and what they portend, I think we're within 2 months, not more than 3, before we see the first negative payroll report, which nobody has seen happen since December 2020. You see, that will be, when you're asking me, what will be the 2x4 that knocks the consensus out of this Goldilocks economic view, is when employment starts to contract. Now, we saw it in spades with the household survey that came out for the month of May just last week. The household survey took a big plunge, and all on full-time jobs.
Yeah.
But that wasn't corroborated, of course, in the non-farm payroll survey. One is a survey of households, the other is a survey of establishments. But just think about what will happen once the non-farm payroll survey starts to look like last month's household survey. And that is when we get the shock that, oh my God, the recession is probably coming. We never had, we never did have job loss in 2022, 2023.
Right.
And you need to have that happen to get the recession call right.
Yeah.
But I'd say the labor market right now is on much shakier ground today than it was 3 or 4 years ago. But I'd say that in terms of the consensus, it's just like, you get a big call wrong, you're going to become gun shy. I learned from my mistakes, and I learned from that mistake. But it doesn't mean I'm going to let it influence me making the next call. Just because you averted the recession in 2022 doesn't mean you're going to avert the recession in 2025.
Yeah.
And it's completely different because, this is when you're taking a look at the level of uncertainty, the policy uncertainty, immigration uncertainty, trade uncertainty, and fiscal uncertainty. And there's measures for these, Jeremy. There's measures that go back in time. The first economist to model uncertainty in a GDP forecast was John Maynard Keynes. And we're talking about levels of uncertainty so extreme that they classify as 3 standard deviation events. And what happens when you have extreme levels of uncertainty is businesses freeze up. They freeze their hiring plans. They freeze their CapEx intentions, at least outside of the AI and data center craze. But you're seeing it in the data. You're seeing capital spending intentions, broadly speaking, pulling back. Hiring rates are peeling back with a lag that shows up actually in the GDP data. And what do households do in a period of extreme uncertainty is they boost liquidity, they boost their savings rate, they become more cautious in their spending, they eat more at home and they eat less at restaurants, they curb their appetite for travel and tourism. And you're seeing that not just in the Beige Book anecdotally, but in the real data. So you're seeing a change in behavior because of all the uncertainty. I mean, the Beige Book, the last Beige Book had 80 citations of the word uncertainty. That's unheard of. Even in Trump 1.0, during his tariff battle back then, we were getting numbers around 20 in terms of citations of uncertainty. We're up to 80. We've never been this high. So there's so many things different now than they were, during that monetary tightening phase that fooled us into thinking there'd be a recession. This is a totally different kettle of fish, but that's what uncertainty does. Uncertainty is the enemy of decision-making, and it's decision-making that drives spending, and spending is all about GDP.
Yeah.
And that's why I think that not just the current backdrop, but the whole outlook is fraught with risk. And I don't think risk that's appropriately priced in to financial assets at the current time.
Interesting. I got to ask you, when you look at the Fed, are they missing it again? Let's talk policy. Obviously, they're holding this 4.25%, no cuts yet. Powell's tone remains cautious, if not, to be honest, outright dismissive of near-term action. And at the same time, just this morning, President Trump said he won't fire Powell, but he's again publicly pressuring the Fed to cut. He called Powell, quote, too late, blaming elevated rates for these ballooning government borrowing costs. Is the central bank still operating independently, or has monetary policy become more politically cornered here?
Well, let's talk about that next May when the next Fed chairman is appointed and confirmed.
Yeah, Scott Bessent, is that who you're going with here, Dave?
No. Well, that's some people are saying that maybe it's Kevin Hassett. I'm not really sure who it's going to be. We wrote a whole report on a range of individuals. So a couple of months ago, people thought it'd be Kevin Warsh, but I think that he might just be too hawkish for Donald Trump. Mm-hmm. Fed policy has not become politicized, not a bit. I think that every time that Donald Trump actually pushes the Fed vocally and in front of everybody to lower rates, reduces the chances that he's going to do it. The Fed cannot be seen as being political. So Donald Trump would be doing himself a favor if he wants the Fed to cut by not saying anything in the public domain. What you say privately, well, that's something different altogether. We didn't know for decades about how Don Reagan in the White House tried to pressure Paul Volcker. That came out in books many years after. How Richard Nixon gave Arthur Burns a nervous breakdown. We only found out about that afterwards. Mm-hmm. Johnson and McChesney Martin apparently pushing him up against the wall. We found out about that in books decades after. But here we are in real time. Presidents don't normally do that because you can't make the Fed look political. So it's a self-defeating endeavor by, doing an open mouth committee and pressuring the Fed. Now, in terms of interest rates, the Fed is caught just like the consensus. This time around, the Fed blew the call on transitory in 2021, and they regret it. And to this day, they believe that their credibility is still rather impaired. So the Fed is definitely once burnt, twice shy. Mm-hmm. They want to make 100% sure that the tariff file is not going to spill over into sustained inflation. I think we all know there'll be a few bumps in the road on inflation. The question is, will it be sustained? What those of us that were in the transitory camp missed in 2021, 2022 was that we did have not a 1970 cycle, but we had about an 18-month wage price cycle. That the inflation fed into wages, which then fed back into inflation. We had a wage price spiral. That happened. And of course, because the fact that the government was paying people not to work for extended periods of time, the corporate sector had to bid up the price of labor to attract them into their firms just as the economy was reopening. It was maybe, amongst many others, one of the stupidest economic policies of all time to continue to extend unemployment insurance to a point where many workers are making more sitting on the couch than they were at their prior job. So that forced the corporate sector, in the face of squeezed global supply chains and with demand starting to accelerate because of the reopening, they had to bid up the price of labor substantially. So we had a wage price spiral. And that took the Fed 500 basis points. And then just through the passage of time and the supply chains coming back on track, that the inflation ended up coming back down. But the Fed is not going to live through that nightmare again. That's still on their minds. And of course, we have, as I said before, less than a year from now, Jay Powell will no longer be head of the Fed. He is obviously, as a human being, very cautious and careful about his legacy. He does not want to leave being compared to Arthur Burns. Although Arthur Burns was a brilliant economist and was a mentor to Alan Greenspan, but he gets the bad rap on the inflation of the 1970s. Wasn't completely his fault, but when you put labels on people, so if you're compared to Arthur Burns, as a central banker, you're not in a very good place. You want to be compared to Paul Volcker, where they built monuments to Paul Volcker, the inflation dragon slayer. And I don't think it matters to Powell that it took back-to-back recessions for Volcker to kill inflation. He goes down as a hero. Yeah. So I think that the Fed, for those two reasons, are being deliberately slow. I don't know if I really buy into the, quote, solid narrative that Powell always uses to talk about the economy. Look, he has a new indicator. A couple of years ago, we had an inflation indicator, which was the supercore price index, which was X energy, X housing services. That number is starting to fall. He doesn't talk about it. When it was accelerating, that was the reason why the Fed should be raising interest rates, that little sliver of the inflation picture. And that's because he was concerned about labor demand mismatch in the leisure hospitality industry in particular, and that was a proxy for it. So it's funny, I've never seen a central banker pick and choose the indicators. Yeah. Now he's got a new one, which is this private sector demand indicator where he says, well, here's what I'm looking at. I'm looking at gross business investment plus consumer spending. And the economy is doing just great. And now they're thinking, oh, excuse me, you're going to look at the economy and strip out housing. You're going to strip out commercial construction. You're going to strip out net exports. You're going to strip out inventory investment. And you're going to strip out government. Okay. You see, this is what gives economists a bad name. Take out everything that's bad. You're left with good, and the economy is growing at a solid rate. It's interesting to me that nobody, and I'll make this prediction, there'll be nobody after the next meeting at the press conference who will ask him about the Beige Book. Nobody will ask Powell, did you read the Beige Book? And if you did, why do you think things are so good when 75% of the country is flat to negative on their economic activity? Or maybe will anybody ask him, why are you so bullish on the economy when your own economic staff is saying that recession odds were at a knife's edge is 50-50? No one is going to ask them those questions, okay? Because nobody wants to make them look bad. However, I would like to ask the question that if you're not going to listen to the Beige Book, why do you spend the money? Sit every 6 weeks on sending your staff into the field to survey business executives. Why are you doing that if you don't listen to them? And why do you bother having an economic staff at all if you're not listening to them? So I'd say that the Fed right now, the reason why he's putting on a brave face on the economy is because if he didn't, people would be saying, well, why aren't you cutting rates? And so he's got to sound like it's Goldilocks right now, so that justifies why he's staying on hold. And I think they're going to stay on hold as long as they possibly can. What will be the triggers for the resumption of the rate cutting cycle? Twofold. First, when we start to see employment going down and we see the unemployment rate cross above the Fed's peak estimate for the year, which is 4.4%. We're right now at 4.2. Now, look, if we didn't get the decline in the participation rate in the month of May, and a lot of that's coming out of these immigration outflows, if the participation rate hadn't gone down, the unemployment rate would have gone to 4.6. But it's 4.2 because of what happened with the participation rate We'll see the extent to which that's sustained. But we have to see the unemployment rate hook up to its target or above, and non-farm payrolls either get to flat or negative.
Yeah.
In addition to that, the Fed's got to be confident that the tariff shocks are not going to lead to persistent inflation. The numbers we've had of late have been very encouraging. But you see, the problem is that a lot of the price data we're seeing right now is being benchmarked off the old inventory. Remember, we had a massive inventory buildup before the tariff file went front and center. So we're working off that lower cost inventory right now. And it could take up to 3 months before we really see the whites of the eyes of the inflation data. And only then, so I give this to probably September to see the extent to which the tariff shocks feed through into the CPI, core PC deflators. Those would be very important. So the Fed is looking at the tariff flow through, how much is being passed on. And of course, the wage numbers as well will be very important because they don't want to fall into the trap of a wage price spiral as well. So I think all those numbers together, they just don't have enough evidence right now. But I do believe the economy is weakening at a more rapid clip than what's being discounted by the marketplace. And I think the longer the Fed waits, and the Fed has its reasons to wait, but the longer it waits, the more it's going to have to do. That may well end up being more of a late 2025, 2026 story. But we have to remember that we're not coming out of this from a position of the funds rate being neutral or the funds rate being below neutral. The funds rate is more than 100%, 100 basis points restrictive, benchmarked against where the neutral funds rate is. So they have a long road to hoe just to get to equilibrium. So I think that we'll get there by the end of the year, but the market's right now priced for September/October. That's probably enough time for the Fed to gauge what's happening.
Yeah.
But then I think that in the next 12 months, the funds rate will end up coming down well below neutral. And that surely is not priced in. And one of the reasons why I remain steadfastly bullish, despite all the blemishes and warts and pimples and scars on the much maligned Treasury market.
Okay, well, we need to talk T-bills. We need to get into the bonds. Before we do, you brought up that big, beautiful bill. We brought up tariffs there briefly. I just need to ask you quickly. I mean, I don't know if you heard about this story, but Treasury Secretary Scott Bessent said yesterday that Trump's tariff hikes will raise about $2.8 trillion over 10 years, more than enough to offset that $2.4 trillion cost of the GOP tax bill, according to the CBO. He's calling that a $400 billion surplus, but the administration hasn't released its own projections. I mean, do you buy the math, or is it just more political accounting?
Well, the one thing that you have to take into account is this tariff revenue is coming out of the private sector. So it's either coming out of the pockets of the foreign producer or it's coming out of the pockets of the domestic supplier. But either way, I mean, think about what he's telling you. He's telling you that to fund these tax cuts, we're wasting money on this tax hike. Because in reality, that's what a tariff increase is. So it's a different revenue raising measure. But where does the government get revenues from at all? From the private sector. Now, you're going to basically depress the global economy. You are doing an assault on this $30 trillion beast called global trade. And there's going to be all sorts of negative multiplier impacts if you send your foreign customers into recession. Because just remember that although the United States runs a trade deficit, it also runs a surplus on the services account. But you throw the rest of the world into an economic downturn, your export sector is going to suffer. And as a result, that part of the profit pie coming from exporters is going to go down. That revenue stream will be an offset. So I just love it when I hear these politicians and cabinet ministers who should know better that we do not operate in a static economic environment. You have to have a dynamic analysis.
Mm-hmm.
So to say, oh, well, look at all these tariff revenues, that's a tax increase on the world. And what you tax more of, you get less of. So think about what he's saying. We are taxing economic activity globally, which means you're going to get less economic activity globally, and there will be knock-on effects and multiplier impacts within the U.S. economy, because the U.S. is part of the global economy. And so there's going to be a natural offset to that beloved revenue stream from tariffs, because it's nothing more than a tax increase.
Mm-hmm.
And so it's so anyway, that's basically it. They're basically trying to fix a leaky boat. We're going to cut taxes at home, and we're going to raise tariff revenue. But I mean, there's going to be all sorts of economic distortions and weaker activity coming out of this. That's also going to have, like I said, a very big offsetting impact to his expected revenue stream, that these tariffs are going to be enough to defray the cost of everything else that's being done right now on the fiscal side. It's a pie in the sky.
Interesting on the tax side too, because I mean, what does that mean if you got wages continually coming down and you're being charged more on the supply side? For stocks, I mean, is it fantasy or fundamentals? I mean, looking at the equities, the S&P 500 is up 9% this year. But when you strip away the headlines, like we've been talking about, these job growths in 2025, it's running at its slowest 5-month clip since the greatest recession outside the pandemic. World Bank, you heard me, now saying that this could be the weakest decade for global growth since the 60s. I mean, should investors be preparing for a prolonged stagnation, or is this just kind of a mild cyclical dip?
Well, we have another situation on our hands where we have an aging population.
Yeah.
And we also have immigration outflows. So, they say demographics is destiny. So the population growth in the United States, and especially the working age population, is decelerating, and for better or for worse, will decelerate more under these immigration policies. So that's part of it. You're left, therefore, on the supply side with productivity.
Yeah.
And you could say that the generative AI boom is a game changer, and it probably is. That'll take place over a much longer time period. The one thing I want to say on that score, by the way, is think about how deflationary these shifts are, these monumental shifts in the innovation curve. You go back to the steam engine, the cotton gin, the railway, the automobile, electricity. We're ushering into a long period here of secular disinflation. People don't seem to realize it. They can't see past the tip of their nose, and we're just concerned about the next few months and what tariffs are going to be doing. Just as the internet was massively disinflationary, generative AI is equally disinflationary. And it'll be, and when they say that, technology ends up creating more jobs than you lose jobs. And for the first time, I don't know if that's going to happen this time around. Of course, the 1980s and 90s, we had automatic banking machines where those tellers ended up finding jobs in other industries. They became either accountants or real estate agents. This time around, this isn't about robots coming in and taking your job in the factory floor. This is attacking the services sector, which is inherently labor sensitive. So you're talking about it's going to affect healthcare. It's going to affect the financial services sector, the legal industry. It's going to cut a wide swath in labor-intensive industries. And it's going to create a lot of push and pull and distortion and displacement in the labor market. You know that the one number nobody talks about that came out of the University of Michigan Consumer Sentiment Index very recently is that more than 1 in 5 Americans now fear a job loss over the next half decade. More than 1 in 5 Americans fear a job loss. So you telling me we're going to get wage inflation out of that? You're going to go cap in hand to your boss for a pay hike with that number? That number wasn't around in 2021 or 2022, but it is today, and it's only been this high 3 other times in the past, and 2 of those times was during the peak of the pandemic anxiety, and the other time was in the Great Recession of 2008, 2009. Now, I am. So I'm a secular disinflationist, and therefore I do like long duration bonds.
Okay.
And so in the stock market, what I like is I like the bond proxies. I like the bonds and drag. We like utilities, consumer staples. Healthcare has cheapened up a lot. It's very defensive. If I want to be in the stock market, and I don't believe in 0 or 100. I'm not 0% in the equity market, but I invest along the cycle. And right now we are not just in the mature stage of the cycle. I think the cycle is coming to an end. But if I want to have toes in that risk pool called the S&P 500, I certainly would not be in the small caps right now. That's for sure.
Yeah.
But I want to be in utilities, staples, healthcare. I want blue chip, dividend paying companies with low cyclicality and low beta. And I want to invest around secular growth. And I guess you could include some parts of technology in that for sure. There's a reason why Microsoft, I said before, there's two stocks you can always own in a recession. They won't kill you, which is Microsoft and Walmart. So I don't mind defensive growth. That's for sure. But the one area, and one of my highest conviction calls, is aerospace defense globally. I would buy the global ETF. It's not just U.S. anymore, because every single country is dramatically boosting. This is the one thing that Donald Trump did accomplish. He's getting, even Canada now, Mark Carney is moving 5 years ahead of schedule for Canada to finally read its NATO commitment. But you got, the Pakistan-India skirmish. I mean, here Pakistan, with a negative 7% spending cut to its budget, is raising its defense commitment by more than 10%. You're seeing it around the world. Japan, former pacifist country, boosting its defense budget because, of course, concerned about China, concerned about North Korea. The big inflection point was, of course, this year what happened in Germany and breaking the fiscal tourniquet. I got to tell you, when the German government starts to turn on the spending spigots on defense, this is a major inflection point. And, of course, defense feeds into technology because Silicon Valley exists because of the military. And it's called Cisco Systems because it's near San Francisco. And San Francisco was home to one of the biggest army bases in the United States for many, many decades. Mm-hmm. So the military, it's called the military industrial complex. It's really the military technology complex. Defense aerospace is, as much as there's a no-brainer in this business, being long aerospace defense is a no-brainer. That's one of our highest conviction calls. That has got, when you look at the backlogs, the order books, the production schedules, and we're still not fully priced in that sector for what's coming down the pike. So that's one area of the stock market. People call me a perma bear. No, sorry, that's a label.
Yeah.
But
I don't see it. Dave.
We invest around our ideas, and that's one of our highest conviction calls, is aerospace defense.
Okay, that's a good tip. I like that one. And of course, you've turned bullish on the bonds too. That's quite an interesting one. I got to ask you, because I got a clip set up here. And earlier this week, I was going through your X, and you flagged that foreign capital is starting to drift away from U.S. assets. I mean, we've been seeing it on the outflows. Jeffrey Gundlach, your longtime friend, of course, founder of Double Line, was on Bloomberg yesterday saying that gold is the asset class to be in right now. That's a shift from him and a pretty strong conviction. Here's what he said, if we could take a listen.
So I think gold is a real asset class. It's no longer for lunatic survivalists and wild speculators. It's viewed as an asset class, and central banks have been accumulating gold. Gold was stuck in the mud because for a decade or more, central banks were selling it down. They've bought it all back.
So are you buying gold?
I've owned gold since it was $300, and I also own some gold miners personally.
All right, he's in the miners too. I mean, David, when you hear from Gundlach, someone that you've known and debated for decades, does this confirm your thesis, or do you still see the rally a little bit differently here?
No, I completely agree with him. I don't know about the lunatic comment, because a lunatic doesn't own something that is as safe and secure as gold. Gold's complexion has really changed. It's behaving less like a commodity and more like a currency, and a currency that has no country's liability. It's obviously benefiting from this correction or bear market in the US dollar, but gold's been hitting new highs in every currency terms, euro, sterling, yen, Australian dollar. Gold has really carved itself out less as an asset class and more as a currency that you can rely on. And it's also got that tremendous hedging quality against global instability and uncertainty, whether it's on the tariff side, whether it's on the U.S. immigration side, fiscal policy. Of course, it's a hedge against fiscal recklessness. That much is true. And think of how well it's doing in this period of very high real interest rates.
Yeah.
That's really quite something, that with real rates above 2%, that you'd have gold testing new highs. Imagine what happens when rates go down, because that's where the big correlation is. And yeah, I think that the US dollar, I think that there is selling, something's going on. What people are selling, I'm not sure. They're not selling the equity market, and the bond market's been stable. Cash in the United States is paying you more than 4%. It is interesting to see, like, what is it people are selling? Because the US dollar has been on a one-way ticket down. That's an added benefit for gold, since we're pricing gold in US dollars. But I also like silver. I agree with them. The gold mining stocks are trading at a huge discount to the underlying commodity price. We also like platinum. So I would say that, yeah, those are other areas that are high conviction calls for us. We've been bullish on gold. I've been bullish on gold probably as long as Jeff has.
Yeah.
I mean, going all the way back to my Gluskin Chef days.
I remember you were saying
you're
this.
bullish on gold. But Gluskin didn't have a gold fund, unfortunately. But you see, that's gold is a ballast in the portfolio. It's a stabilizer. And so are bonds. You know, people tend to forget, like, you don't buy gold or bonds to make a killing. Of course, gold was up almost 30% last year, up almost 30% this year. That's great. We did a whole research report on this, mapping out this bull market in gold. And it's behaving in such a way that the peak is probably going to be in the next 5 years, $6,000 an ounce. So this is buy and hold for us. And of course, the gold mining stocks are trading at massive discounts. That's, again, something that is as close to a no-brainer as I could think about, because you don't have to do a lot of guesswork. Jeff Gundlach was right. The central banks are diversifying. You see, this is what's happening when we're talking about selling. The central banks are selling the dollar and they're diversifying into gold. And this can go on for a long period of time. Jeff Gundlach was right. That was back, I think, in 1999, where the central banks, the European central banks, put on the moratorium on gold sales. They were selling gold. It was nobody's business for over a decade. And so you can't underestimate the deep pockets of the central banks. We know that through relentless QE that started with Ben Bernanke. There is a global shift towards gold. And of course, it just replaced the euro as the second largest reserve asset on global central banks. So very bullish on gold. I think it's gone up a lot. It's not going to go up tenfold from when Jeff Gundlach bought it, but do I think that it will double from here before we see the peak? Yes, I think that is a very high likelihood. The gold mining stocks, I think, offer tremendous optionality based on where they're priced right now, because the gold mining stocks are not priced for my forecast for gold, nor are they priced for where gold is trading at right now. So if you're looking for buying cheap assets, there you have it. What I like, and I mentioned that within the stock market, I want to play defense, not just the aerospace defense industry, but I want low beta, low cyclicality. I want high visibility when it comes to earnings, but I want to get dividends, especially because I believe rates are going to come back down. So yield is going to become scarce. And classic David Ricardo value of scarcity, I want to own yield in the stock market. So I want companies with strong dividend payout ratios and a good front-running yield that you can't get, say, in the Treasury market. The Treasury market is the same thing as gold. It's a ballast in the portfolio. You don't own... I'm sick and tired of hearing people talking about the end of 60-40. You don't own bonds to make a killing. Maybe you want to own Bitcoin to make a killing. You don't own bonds. You own bonds as a stabilizer, a ballast in the portfolio, because bonds have completely different characteristics than stocks do. That's what people don't understand. It is a true diversifier in the portfolio. You don't own it to get rich. You own it so that you don't go to the poorhouse when you go into a recession and you have a 30, 40% decline in the stock market. That's why you want bonds in there. Okay, because the one thing about bonds are the certainty characteristics that don't exist in the stock market. Bonds have some risk. Of course, they have duration risk. You could say they have cyclical risk in the bond market. Inflation risk, duration risk, cyclical risk, fine. But it doesn't have capital risk. There's no other asset class in the world other than the Treasury market where you know with perfect certainty what you're getting paid after either 5 years or after 10 years. You know the certainty of payment. You know the certainty of maturity. Stocks don't have that. Stocks do not have any guarantee of payment, but the bond market does. So I continue to hear about bonds are for losers. No. Bonds are for, if you own fire insurance, auto insurance, home insurance, property insurance, theft insurance, bonds are insurance in your portfolio. And everybody should own at least some of them. I own a lot of them.
Well said. And that 30-year Treasury, I mean, is that still that classic kind of, safety play? I mean, it feels like it's kind of come down a little bit. People are hedging with the gold instead.
Well, look, there's more duration risk. Okay?
Yeah,
so people say to me, go to the 10-year part of the curve. I mean, the Treasury market right now is carrying very, very nicely. You are getting a yield pickup at the long end of the curve. You're close to 5%. But I can understand when people say to me, I'm concerned about all the Treasury supply. I'm concerned about fiscal policy. That's the maximum duration risk is right out the curve. I would still say so if you don't like the 30-year, so buy the 10s. And then let's just do the math. Because when I look at the situation, we could either be up or down 70 basis points from where we are right now. Mm-hmm. And if we go up 70 basis points, if that's the next big move, you'll be flat on your 10-year Treasury note from a total return standpoint. That's why I chose 70 basis points. The question is, at what point do I start losing money on a total return basis on my 10-year Treasury? Now, you remember that back in 2021, when the 10-year was like trading barely above zero. There was a time when it was trading barely above zero. It only took a 6 to 7 basis point increase in the 10-year note to cause you to go into negative return. That's why people ditched 60-40. Well, because we had this extraordinary period called the pandemic and central banks pinning rates to the floor, massive QE. That was a asterisk in time. That was the first global pandemic in a century. But you had no coupon protection. So today, the coupon protection, I call it roughly 4.5% of the 10-year note, or 4.4. The coupon protection is so significant that it would take 70 basis points of an increase for you to have your capital wiped out, to make no money or lose money in the bond market. But let's say we go down 70 basis points, and we just, God forbid, go to the levels we were at last September. Your total return in the Treasury market is going to be, in the 10-year, is going to be 15%. Now, if you see that in the 30-year, and this is the allure, is the convexity and the duration, you get that sort of yield decline in the 30-year, which, by the way, will happen whether or not we have these large-scale Treasury auctions at the deficit, 7% of GDP. In recessions, Treasury yields always go down, even in the 1970s, because you get a contraction of private sector credit that opens up the door for the government to do more borrowing. Deficits always go up in a recession, but bond yields go down because you get a contraction in private sector credit. I can't believe how many times I have to go over that over and over again. The deficit balloons in recessions, yet market interest rates go down. Go figure that. Well, that's the reason. You go into private sector credit contraction. You get that sort of decline, 70 basis points, the 10-year note. Jeremy, you're talking about a 30% return in the long bond.
Yeah.
So
that's significant.
It's more risky. It's more risky because there's more duration. However, the risk reward profile is actually pretty attractive. You want to play it safe. I say go to the 10-year. If you have a little bit of ice in your veins, which is almost an oxymoron to talk about a bond trader with ice in their veins. I mean, it's not Bitcoin. But I think that, again, it's about idea generation and investing around your conviction that the long bond or the 10-year is going to deliver equity-like returns in the next year. Most people don't like that because bonds are for losers. And believe me, if you go to your cocktail party and you talk to people about the Treasury market, they'll run away from you.
Yeah. They'll run away. It's one of those topics. Well, I mean, it's interesting here. And I was just doing a little bit of research while you were talking about the bond market. And there was that auction today. It looked like $22 billion on the 30-year bond sale was strong. I mean, the yield came in at 4.844%, below market expectations, but obviously solid demand. Foreign buyers took 65.2, slightly less than average. But to your point, Dave, I mean, yields dropped after the auction, but it's easing concerns about this waning appetite for the long-term U.S. debt, despite these deficits and trade tensions.
Well, a good day to print a pair of 0.1s on the PPI and core PPI, just like yesterday, doing the same with the CPI, because the 10-year Treasury note yield, that auction was pretty decent as well. So good timing by the Treasury Department. What more can I say?
Yeah. And well said by you. Listen, I appreciate this. Thank you for your time as always. David Rosenberg is the economist and founder of the Rosenberg Research, which if you haven't signed up for, by the way, you should. Always sharp, always data-driven. Thanks, my friend.
Thank you very much. Take care.
Thanks, David. Appreciate your time. And I'm Jeremy Safran. For more expert interviews and market coverage, subscribe to our YouTube channel and visit Kitco.com. Thanks for watching. We'll see you next time.